Hi, I'm Sam Sells, and welcome to my podcast, Clean Money. I'm a serial entrepreneur that has led over 2 billion development projects around the world. But the work I am most proud of is the work we do here at Wild Mountain Capital. We not only create great returns for our socially conscious investors, but we make an impact in the many communities we work in, and we change lives. I like to say investing matters, and my show is to talk with everyday folks that are not only creating great success, but making an impact in society and improving the lives of others. That is my mission, and I want to share my stories and others with you. Welcome to Clean Money. Everyone, thank you again for joining us for another great episode of Clean Money, where we talk about making a difference in the world through our investments of time and our financial resources. Our guest today is Lane Kawaoka, and Lane is a renowned real estate maven with a track record spanning over a decade, steering a remarkable portfolio of over 10,000 units, and he stands at the helm of the Wealth Elevator. Lane is a published author. You're just completed your second book now, is that right, Lane?
Yeah.
And you're also a licensed professional PE, civil industrial engineer. Your expertise extends to orchestrating capital construction projects surpassing $250 million in both public and private domains. Thank you so much for joining the show, Lane.
Hey, thanks for having me. Aloha, everybody.
All right, so you're coming out of Honolulu, where it's not freezing cold, and of course, the States it's cold right now. But tell me a little bit about, what's not on your resume. Like, who are you? And you've been doing some really amazing things, but just tell me a little bit about yourself and why are you here?
Yeah, I mean, I think a lot of it just has occurred just because of doing one thing and just time. A lot of time has passed. When I first graduated college back in 2007, I was what I call on the linear path of studying hard, invest in the 401k. I became an engineer because I happened to be good at math and science when I was in college and high school. And, I think we all know that, the linear path. And I started to work a job, wanted to buy a house to live in, just like anybody else, or brainwashed to think that. And bought that house pretty quickly in my early 20s, started to rent it out. And that was kind of where I realized, wow, there's a different path out there that not a lot of people go on of rental real estate. But that was way back in like 2009. But, just a regular guy, right? That let, the power of compounding interest just rack up and maybe got a little bit more sophisticated in the 10 years doing it. But that was kind of the start of this all.
So tell me about that journey then. You got started in, doing rental homes, and then you continued to grow. Tell me about that growth over the past 10 years, because a lot of people, most people, when they get into real estate, they buy the first home, it's their own house, and then they either move and they rent that house out, or they watched enough Instagram reels or YouTube channels, or they read Rich Dad Poor Dad, and they're like, I'm going to buy a house and rent it. So you've clearly moved on from that. I mean, you don't get to 10,000 plus units from just doing one house at a time.
Yeah, I mean, my unique thing initially starting out was like I was able to save a lot of money from my day job. And part of that was just I was single at the time, didn't have a family. And, there was a while there when I first started, I was saving like maybe 50 grand per year from my paycheck.
Wow.
I didn't have a huge phenomenal salary. I mean, when I was first, graduated, I didn't get paid six figures quite yet. But I was pretty frugal. And then I had this job where I would travel on the road all the time. And, as a lot of young professionals are kind of put into that role because you don't have any family. And it's kind of fun too. And for me, it was like super cool because I got to just go on company expenses all the time. I didn't have to pay for any food. I would gouge myself at the buffet and not eat during the weekends, basically. It was kind of a game, in fact.
Yeah.
And because I was traveling all over for work, after I bought that rental property, or one of the things that kind of made me push me over the edge of turning that house into a rental was that I could live on the road and I had no, mortgage or rent. So that kind of propelled me up to saving pretty much 100 grand every single year. And when I work with my clients, at the end of the day, this is just personal finance.
Yeah.
Sure, you can invest in this and that, and some investments get you 10%, some might get you 20. That's kind of in the range of the real estate world. But one of the big levers you have is like how much throughput you can put to this thing, how much money you can net. It doesn't matter if you make 400 grand a year, 500 grand a year. If you only net 50 grand of it, that's all what really matters at the end of the day. I mean, some investors make 250 and they only spend 100 of them and maybe net 150, 100 and going to savings or should be going to investments. But that was me. So from 2009 to maybe at least maybe 5 years, I was like stacking chips up maybe 3 or 4 times faster than your average professional, and bought a few properties, a few units in Seattle, Washington. Started to realize that the rent to value ratios in primary markets just no bueno, doesn't work.
Right.
Started to do the turnkey rental thing from 2012 to 2015. Had 11 rentals by the end of that. And then I think like a lot of, like your story and a lot of other investors, you start to realize the single family homes just aren't scalable. And I kind of woke up to that around 2016, 2015 when I had 11 of those things.
Yeah. Yeah. I remember when I learned how to invest in multifamily, and mobile home parks, storage, I went back and looked at that point, like I was selling off my single family portfolio and moving into that portfolio and growing multifamily. And it just was so much better, like less stress when you buy big apartment complexes or when you invest with somebody who's operating a large, mobile home park, large apartment complexes. Like there's so much money there that pays for people to manage things that you don't have to manage it yourself. And it becomes far more passive. I don't really like the term passive because it's inaccurate. We should always be paying attention to how we invest. We should always pay attention to what's happening with our investments. It's just whether or not you're doing a day-to-day job of managing it. When you're got single family homes, a toilet breaks, they're calling you, or they're calling the property manager who then calls you, and you're like, don't. That's just not what this is supposed to be about. That's not what Rich Dad said. It's supposed to be passive. And the only way you really get that is when the machine's big enough that there's people that are paid to do that. And yeah, I sold my last single family home, I think back in 2020, maybe 2021. And I haven't looked back since. Like I will never buy single family homes again. Maybe for myself, but not as investment properties. Just won't.
Yeah, I think that was for me 2000. I mean, I started to sell them off in 2017. But I went into syndicated deals prior to that because, I had a little bit of liquidity and the way I do things is I always test something out first, try it out, and then I kind of move more confidently in. Just like when I had the few units in Seattle, I bought a turnkey rental in 2012 in Birmingham, sight unseen, tried it out, and then I kind of switched the portfolio to that mode. Kind of did the same thing with the syndicated deals. So, and I think for me, it was mainly getting around other purely passive accredited investors. And it all kind of made sense. But that's the problem is like, if you're not around accredited investors, like how I was, I didn't have a rich uncle.
Yeah.
I didn't have, I just had the people in the cubicle land in the engineering world just tell me just the wrong information. Invest in 401k and do this pension thing, like you start to realize even when you have just a rental property or two, that's wrong way of doing things. But you don't have those people that are accredited saying, yeah, I used to own 11 rental properties and I traded them in for syndicated deals. Like that's just another level.
Yeah.
And it's kind of funny. Like there's talking to an investor the other day and they had this story of like they're you go through this grind. Like when I had 11 rental properties, you're kind of on the phone all the time for stupid stuff, even though you have property managers that are supposed to take care of
Yep.
it for you. But with, 11 rental properties, I'll tell you, you have like an eviction or two every single year, some kind of big catastrophe that happens every quarter with that kind of sample size. Not a problem, right? I mean, but for 11 rental properties, maybe you have like about $3,000 of passive cash flow every month after expenses and capex. That's not enough. Like most of my folks, we always say like you need $10,000, $15,000 per month. So you're talking about a portfolio size of 30, 40 properties, therefore an exception rate. Now, so that means,
Minimum. Yeah.
yeah, you're doing eviction every other month or almost maybe even every month, who knows?
Yeah.
And then some kind of big catastrophe every week. And yeah, your property manager is supposed to deal with that, but you're the one bird dogging them, getting it done. And it's just, you start to realize it's just not scalable. And then, that's kind of where, yeah, start to sell off the rental properties. There's some great websites out there that target unsophisticated turnkey buyers. Great place for you to sell your property to them. I think everybody's got to go through that rental property experience, kind of like adolescence, that's
Yeah.
all awkward phase of your life. But, selling the properties and then in conjunction, because I had gone into syndicated deals, got the past losses, that was kind of how I was able to offset the capital gain and depreciation recapture from those single family homes and kind of made my transition in from a tax standpoint.
For those listening to this conversation, if you are getting started in your investment journey, listen to two old guys, Lane and myself. Highly recommend that you skip the adolescent phase of I want to buy single family homes and rent those out, and I want to get that experience and all the pain, and I want to learn the hard way that that's not what I want to do. I just highly recommend just skipping that phase altogether and do something better with, a single investment with 60, 70, 100, 150, 200, 300 units is so much better, so much more passive for you, and you'll have a lot less pain, and you should make more money as well.
Yeah, I certainly think you're correct for like accredited investors. My new book, The Wealth Elevator, I kind of break down the steps or, the floors, right? That's kind of where the construct comes in. There's a lot of people in like the basement level. They have a net worth of under 100, quarter million. They make less than $50,000 a year. I think that those are most of the books written out there for those types of people.
Mm-hmm.
The Susie Ormans, the Dave Ramsey. So I kind of identify the people in that floor. I feel like there's kind of people in that adolescent phase. I call it the first floor of the wealth elevator, and that was kind of where I was at in my early 20s, buying rental properties from 2009 to 2015. My net worth was under $500,000. I made a good salary though, right? I was, they call them Henrys, high income, not wealthy yet, but I think for those people, maybe buying a rental property or a few, certainly don't be like me and buy 11 of them. But yeah, like, I think for most of your folks listening, like if you're an accredited investor, make over 200,000 a year, certainly net worth million or greater. Yeah, there's really no reason why you want to do the single family home gig, because another thing is maybe we should have started this at the top. Like we're not wholesalers or flippers or like, burst strategy people. Like to me, those are for broke guys, right?
Yeah. Hey, that's where we got started though, right? You got started there.
Yeah.
That's where I got started. I started flipping homes in 2005, 2006. And we probably in 2006, we probably first year did 7 homes or 8 homes. We just jumped right in and started doing it and learned a ton. But the market was a lot different then. I was buying homes in San Antonio for $50,000 a piece and
Yeah.
flipping.
Well, you were a lot better than I was. I mean, I was broke guy, right? But I certainly weren't doing like the buy rent rehab strategy. I was just buy hoping and praying. Slap a 30-year mortgage, and from 2010 to 2022, it was good market. You could do that buy hope and pray strategy, but when you start to realize that most of the returns are made through value add, and the only way to do that is to, take down a larger project, and the only way to do that is to entrust a general partner who gives a damn. Right? You can't do that with a property manager or third party. I think that was to me the aha moment. I was like, all right, yeah, I can get a few $100 from every one of these rental properties, slap a 30-year mortgage in. But when you look at the syndicated deals, especially like the ones that were done in the last 5 years, when you look at the color of money, how much money you're making from your projected returns, the majority of it, like 2/3 or 80% of it, is coming through the value add. A very small portion of it is coming through just the pure cash flow, buy, hope, and pray portion of the strategy. I mean, yeah, some of it is being pulled into, paying for more capex and value add. But for the most part, if you follow the money, the way you're bumping that net operating income is coming from the value add, and the cash flow is just one part of it. And that's a very small minority of it.
Yeah. Let's talk about different asset classes and types of assets. So you've invested in Class C and B apartment complexes or multifamily, like we like to say, RV parks, mobile homes, hotels. What's your favorite asset class or type?
Yeah, I mean, we started with the Class B and C, the real rough properties, because quite honestly, that's where you start when you're broke, when you can't raise too much money, and that's where you start.
Yeah.
You can make a lot of good money doing that. You're gonna need a good market too, and some trade winds behind your back. But I think the two big things I look back and I'm like, man, like on some of those, like only 80% collections, meaning like
Mhm.
4 out of 5 people will pay you. So 1 out of 5 people are just deadbeats.
Yeah.
But you can do so much value add because you're buying the properties at, distressed prices. And, it's like owning like a 96 Honda Accord in today's age. Like things will just break on you. Like you can do all the due diligence you want, bring in like third parties and spec stuff, but it's just an old property. It's like grandma being 95 years old. Things are just going to go. Um,
Yeah,
so
we've learned that the only way that you can increase collections is you have to bring in a lot of services. So nonprofits, Section 8, a lot of those things, because um, it's just a different clientele, and they've lived their lives where they haven't had to pay, or they go from apartment complex to apartment complex. And I remember we had during COVID, we had this one resident said, "Hey, president said I don't have to pay rent anymore." I was like, "No, did you lose your job?" He's like, "No." "So you're still making money?" "Yeah." "Well, you still have to pay rent." He's like, "Well, they said I don't have to, so I'm not going to stop." And so that's your that's your group. That's your group. When you're at a Class C property, that's just where you're at. And so you do have to evict because people decide not to pay you. It's not they don't have the money. Now, if they don't have the money, then you have what we do services to go take care of them. But either way, it's a lot of work. It's a lot of
yeah,
work.
during COVID, we would have the PM sit down in the lobby with the people and fill out those forms to get their rent page. That's the kind of stuff that you
Yeah.
got to do. Um, but like I'm not gonna say, in this business, it's rarely a debate. People are split on all kinds of things. Like, do I use in-house property management? Do I use third party and churn through a bunch of them? Do I do Section 8? Do I not do Section 8? Do I do like distress, really good pricing, Class C properties, or like how I'm saying, I prefer a little bit nicer properties. Going back to the Section 8 thing, I would prefer properties with no Section 8, or less than 5%. But, I think that's just personal preference.
Mhm.
And I think, one of the things is like we try to go after, loans that require 90% occupancy or greater, especially agency financing. But, I think the more risk you take, the more, as the saying is, like, if no biscuit if you don't risk it. So each to their own. I think over the years in 2020, we went over $1 billion of assets. We started to do more Class B assets. Still, you have problems with collections, but nowhere near like 80%. Dropping down lower numbers. But I think where I'm kind of coming to, I mean, right now you're kind of in this strange bubble where there's a lot of new inventory coming online, which really hurts, which really hurts like the lower end types of
Mhm.
properties right now. So I think there's a bit of a micro trend that might last for another few years of buying the nicer properties. I think what we saw in 2021 is we started to develop workforce housing because what we realized is we could build something for 150, $200,000 a unit. And yeah, you got to go through the painstaking process. And, I mean, this is kind of where I brought my engineering background, taking projects from cradle to grave. And that was kind of where it's like, why would we buy something that's like 50 years old for 150,000 when we can just pay a little bit more and get it brand spanking new? And oh, by the way, the clientele is a lot cleaner and nicer, and collections are a lot better. But I think of what I've kind of realized is like all these strategies, these asset classes that you're saying, like kind of dabbled a little bit as a passive investor, did some funds with RV parks, mobile home parks, hotel. I think our area expertise is the multifamily world and the development of multifamily. But now I'm kind of realizing, as I start to swim upstream, it's more you got to diversify. And now I'm even kind of getting outside of the world of real estate, more private equity, buying $1 to $10 million revenue businesses. And, because at the end of the day, like you have to add value to businesses where it's real estate or
Yeah.
businesses, and they're individual investments at the end of the day.
What's nice about real estate is if you want to learn how to buy companies, well, when you buy a 200 unit apartment complex, that's a company. It's its own company. It has its own managers. It has revenue. It has assets. It has employees. It has like the whole thing. Um, and you still do marketing to bring in new residents. You still do qualifying and everything else. It's a great, easy, I don't know about easy, but it's a great step in the direction of now to go to private equity. Again, same with private equity, you're generally leveraging other people's money along with your money. It's just at a different scale and in a different way. We've been working with a lot of, because I do coach and mentor people. I've had so many people over the years ask, and I started doing it a couple of years ago. And as we've helped create millionaires, it's been fantastic. But we've had people naturally say, well, Sam, somebody offered me a whole bunch of FedEx routes. What do I do? I'm like, it's a business. So let's look at it. What's the EBITDA? What's the revenues? Like, what's your plan to grow it? Like, how do you add value to it and everything else? And all of a sudden, we've been helping people buy all sorts of companies at the same time. And it's all in that same path of like, how do I go up this wealth elevator that you wrote a book about? Like, how do I go up? How do I learn? And the only way you get there is by changing the way you think, learning how people operate at a different level, and then go and do that thing. I'm listening to you talk about, your shift to development, and we've done the same thing. We're in the process of developing a 350 unit apartment complex, and a section of that will be master leased to the city of Las Vegas. So they're doing 92 units right out the gate. So they get it. It's for their certain subset. They pay the rents, they pay the leases, they manage that resident base, and they just write us a check. And that check is a wire every first of the month for all 92 units, and they give us $5 million towards the build. And so if it's $200 or 200K a door, we just got it subsidized quite a bit. So now we're building almost the same thing like you said it would be to go buy a distressed, ran down Class C property that has about a $2 million worth of plumbing issues under the dirt waiting to explode because the pipes are 50 years old. And we don't have to deal with that stuff because it's all new from the beginning. It just puts us in a fantastic position, and our investors in a fantastic position, just like as you go. So like I'm listening to you and I'm thinking about myself and my own journey. Um, and, and it seems like the natural wealth elevator, right? As we go up and
Yeah, yeah. I mean, each. I think that's the key is like you diversify into individual projects. I always say you don't want to have more than 5% of your net worth into any one deal. Um, you need a lot of money and you need a little bit of a war chest if you're talking minimum investments, 50 to $100,000. But I mean, multifamily is great, but you never know. I mean, I got rocked from this correction 2022 to 2024. I mean, prices came down 20-30% at least off the peaks.
at least like
Um,
Memphis markets down almost 60%, you know,
wow.
and it's just that one crushed us. We have a little property there and it's just 95% occupied, but man, the
Yeah, it's
correction
like
just,
it's the prevailing cap rates. Doesn't matter if you ran the assets at 150% occupancy and your
yeah,
NOI is up. It's all, I mean, that's the market, and but that's how like, corrections happen. It goes down pretty quickly, maybe in a year or two, but it goes up very, very slowly. But there's all these different, sectors out there. I think multifamily and office and self-storage, they all kind of generally go on the same flow as commercial real estate asset class. Your single family homes have kind of stayed where they're at because it's a different loan dynamic with 30-year amortized loans, not resetting. But the stock world is all-time highs, right? For some strange reason, I don't know.
yeah,
Um,
it's emperor with no clothes on underneath the robes. That's what that looks like to me. But yeah, commercial real estate it's just been pounded on the past couple of years, just pounded on. I think that's going to change. If you could look at your crystal ball, what do you think is going to happen for the next year or two? Um, New administration. I don't know how much that's going to change anything. But what do you think? Like we're seeing interest rates come down. We expect interest rates to come down a little bit more, but I don't think they're going to come down a ton. What do you think, Lane?
I go off of what the pros say. So you look at CMG Financial and the Chatham Financial Curve. I would have everybody bookmark those pages. The reason being, those are the rate cap providers. Like when we buy rate cap insurance for our projects, those would be the kind of the major players. So you're not talking about like, looky loos or random people on some financial news center. We're talking about the people who have skin in the game, pricing those types of stuff. So, but what they're saying right now in late 2024, you're going to see the interest rates come down a full percent point over the next, by this time next year. So that should put us into the high threes. They're saying long term, and I'm citing the Chatham financial curve on this one. It'll kind of settle into 3.5 range, but go no lower. Of course, something will happen in the world, right? We call these black swan events, and a black swan event happens. I don't know. What do you say? Like every 50% chance of happening every 8 years. Like,
Yeah, yeah. So COVID was
yeah,
a black swan event, right? Like it just
yeah,
came out of nowhere and disrupted
yeah.
everything.
We could have a war start at any point in the next 5-8 years. Yeah, and this is where I always like, in a way, I do a little personal journal where I'm like, well, what were the potential black swan events that hadn't happened? And one thing I look back and 4 or 5 years ago, maybe it was even 7-8 years ago, like everybody thought Kim Jong-un was gonna blow us to kingdom come, right? But then that kind of blew over, right? But then it became another black swan event, like the Taiwan China thing, and
Yeah,
now you have the Ukraine and the Middle East escalating, and but you always have something. There's always freaking something
yeah,
that typically doesn't really, you know, be uh, turn into a black swan. But you have your projections, right? You have your Chatham financial curve projections, what interest rates. But if you believe like the short term, the next 1 to 2 years, it should come down. And when interest rates, what I've heard through some white paper, one of these financial firms is the cap rates is what we're looking at, right? That's whenever you underwrite a deal, you need to put in the prevailing and the exit cap rate or the reversion cap rate. If you don't understand what this is, you need to, because as a passive investor, this is the number one sell on the sell sheet where the syndicator operator will fudge to get the numbers that they want. And what this number is like, what is this wild guess that the market's going to be when you sell 3, 4, 5, 6 years later? And what you want to see is something that is, assumption that you're selling it in a worse market than today. Certainly not a better market. That would be an optimistic pro forma. So part of that is like, well, you don't really know where the prevailing cap rates are going to be in the future, but the interest rates are 70% correlated with what those cap rates are going to be, because that's your cost of capital. And
Right.
as a buyer, when interest rates were high the last couple of years, we didn't really buy anything because the interest rates were too high. But at some point, you're going to hit equilibrium. And I think we're starting to see it, which is why you're seeing the BlackRocks and the KKRs come in at this point. The professionals are coming in, but it's just a matter of time till the prevailing cap rates change. And we just saw 75 basis points come down. I don't think you're going to see the cap rates come down 75 basis points come down right away. To me, it's like there's a lag, like a 6 months or maybe even a 3 year lag to see those 75 basis points. But like I said, based off projections, you're going to see it come down of another 100 basis points or maybe even more. But to see that cap rate impact come down, even off of the 75 basis points, like I said, it's probably 6 months to 3 years happening. But I mean, those are good signs. Longer term, you have to kind of enter now. And as Warren Buffett says, you got to act when people are fearful and think people are uncertain and fearful. But now is that time where the Fed has signaled what they are going to do. And it's a pretty common interest rate. You bump it up quickly and then you lower it down slowly, assuming a black swan event doesn't happen.
Thank you for bringing that up. We look at a lot of other people's offerings, a lot of, what are other syndicators, what are other firms doing in the market right now? Big firms, small firms, just kind of what are they doing? We're not in competition with them, but we're just interested. And we saw a syndicator, big name. They raise a lot of capital all over Instagram, all over a lot of the other networks, lots of content, and dug into their deal a little bit. And it was a Houston deal, raising, I don't know, 15 or $20 million for this project, buying at a 7 cap, expecting to sell in 3 to 5 years at a 5 cap. And I thought, Houston, for one, has submarkets on submarkets on submarkets, and I'm always been pessimistic. I used to live in Houston. I've invested in that area. I'm can be great, but there's so much land that they just keep building and building and building. So it's not like you're in California where all the money you can't build out anymore, right? And so because you can keep building and building, there's you don't get the drops in cap rates, you don't get the cap rate compression and all these other things. And I just thought to myself, there's no way that in the next 3 years they're going to have 200 or more basis point drop in the cap rate. I don't see that, and I don't see annualized 5% interest rate hikes, particularly with if they're trying to push out 5 million immigrants back out of the country, which I don't know how that could even happen, but you're talking about that's 5 million renters that are going to leave the country or more. That I don't see it. I don't see occupancy rates going up. I don't see cap rates coming down that far. Not like that. But maybe I'm wrong. I mean,
Yeah. I mean, you could be wrong, hopefully, right? I mean, I think that would help everybody.
Yeah.
But yeah, normally you want to see that. I mean, the reversion cap rate in that case was like in the fives. I don't think you're going to see that happen for another 3 years in Houston in particular. I don't know if it's class ABC. Sounds like it's more on the class C side there. But yeah, normally just not even talking about any, particular market. Normally you want to see that reversion cap rate pretty similar to the entering prevailing there. So that would be a rather optimistic pro forma. And that's what's hard for investors is like, everybody shows you the same ROI return at the end, but what were the inputs? What were the cells in the spreadsheet? What were the cells in the model that got you that, right? Because those are just easily taken out. So, yeah, I think that, but that's what's hard. Like, I think as passive investors, you're never really given the rent rolls, the P&Ls to kind of do this analysis on your own. It's always with somebody's model. And typically, the general practice is operators don't want to really have the model float around out there for multiple reasons,
Yeah.
legality, and competitors can sharpshoot their bids in the future, and it is a competitive environment out there, which is why we prefer not, to play less and less in the space, because it is very much bid dependent. And but yeah, I think that's something you bring up a good point there to kind of understand these things in particular. And for Houston, like as of a couple of years ago, we kind of took the stances like we don't want to do any deals in Harris County,
Mhm.
which is pretty much like the inner city Houston, because of taxes have just skyrocketed there. If anything, we play around the outskirts up in
And
Conroe.
insurance as well there has also skyrocketed since the hurricane.
Yeah, not as bad as Florida though, which
Yeah.
yeah, which I've learned is kind of a different case out there. It's more of a we kind of in a way we kind of do it to ourselves as people. There's a lot of claims, is what I heard is the problem in Florida when you compare, and that's what's pushed the prices up because there's claims that come out, but then there's additional lawsuits that get put on by the people on those claims, and you got so much like litigation costs. That's why the cost of insurance has gone so much in that particular state.
Yeah.
But I think
Yeah.
they
Makes
just
sense.
it's people don't understand that, so they just said, "Oh, it's near the beach, it's more
Yeah.
expensive." I'm like, okay,
Beautiful.
yeah,
Yeah.
don't worry, don't worry about these droids, right? That's the reason. That's the narrative.
It's not the droids you're looking for.
Yeah,
Don't worry
yeah,
about these cap rates. They're going down. They're
yeah,
dropping big time. No,
yeah.
no, they're not. But thank you for sharing that too. I I think for when you invest $100,000, when you invest $200,000 with somebody, that's a lot of trust. Even if you have a lot of money, um, I have a friend who today is investing $5 million with us on a project. But I've known him for years. He's watched our journey, our good stuff, our bad stuff, like nothing to hide. Um, and he took that leap of faith, and there's risk in the market. There's also risk of the operators. There's risk of, I mean, there's a lot of risk in there. How are you? I mean, you've been doing this now for a while. You've done a lot of units. You've invested with a lot of different people. What are you doing today to mitigate your risk?
Well, I mean, your buddy knows you, right? And I think that's the key. Never work with anybody unless you have somebody who's invested with them in the past. But that's the first problem is I think most people focus more on like interviewing a lot of sponsors and operators, or the worst thing is like going in YouTube and podcast land down the list.
Mhm.
Like I think people are going about it the wrong angle, and they need to start with the passive investor and find a cohort of other purely passive investors, because that's the gold standard of referrals. The first deal I invested as a LP was in 2012. I just got some random referral by some guy who worked at a booth at an IRA company. And I look back, I'm like, that was so dumb. That dude didn't even invest. That guy was probably a broke salesman,
Yeah,
What does he know? Other than he probably drank some beers with the operator the night before, got some kickback or something.
yeah,
But like I said, like when I first started this, I didn't know any accredited investors. So I think like community, I mean, that's why I, do an event in Hawaii once a year for purely passive accrediteds, and that's where you break bread with people, you get to know each other. And that was kind of my big aha moment when all the time when I was investing in single family homes up until 2015, I just did it all by myself. I mean, I'm a bit of a hermit and introvert. When I start talking about this stuff, it's fun because it's changed my life, but up until that point, I just did it all by myself. But then I realized, wow, like you can all these tax strategies, your infinite banking, your alternative investments, even outside the world of real estate. right? Like all that happens organically by talking to other purely passive investors and more building relationships with them. And this goes well beyond, like, I mean, there's a lot of these silly like internet forums out there, which is filled with a lot of fake reviews and fake people and bots. Nothing replaces like face to face, but you need the kind of like that. You need to have a gatekeeper, and that's kind of the position that I play of vetting the right people coming to create that safe environment. But that's, you know, you have your buddy has that with you, right? He
Yeah.
trusts you. You guys are
We've had a
friends.
lot of face to
Sometimes
face time,
sometimes
but
it's good not to have those types of people because they've seen you, you know, in the college years, right? But
yeah,
jokingly aside, I mean, you it's a lot of money. I mean, 100 grand. I mean, for me, that's like 2 years of, you know, heart, sweat, and tears. And as a passive investor, you don't know all the ins and outs, and you're just going in a venture, and that's why I stay still diversify, right? You may not have to worry about the counterparty risk, right? Which is counterparty risk is when, you know, the operator runs off with the money or does something like fraud,
yeah,
but you never know what's going to happen with the deal. I mean, this last, you know, downturn, you know, nobody could have predicted. I mean, not even the, you know, the Chatham financial curve never predicted. They were wrong hundreds of times on this, and everybody, you know, got hurt with how quickly the interest rates went up 40-year high. And if you went in with, you know, bridge debt that was under 3 years, even 4 years, you would have been in a tough place.
yeah,
Now, you know, when we look at deals, I'm like, well, I want debt that's going to bridge me over at least 5 years is kind of the criteria. But you can do that now because the prices are all low.
yeah.
But these are the lessons that you need to kind of pull out of the basket in 2029, 2032 when things are frothy again.
Yeah, thank you. That the past, I've been on my own in commercial real estate since 2018, with our own company and doing our own projects. And we took investors in 2019 for the first time. Um, and taking the experiences of 2008 when I was flipping homes, and then building, stuff for the public sector for years and years, and then doing what we're at now. This roller coaster has been crazy. The past 3 years have just been bonkers. 2020, we started buying stuff like at great prices, and then the market went out of control. And we had, I think we had 20 something, 24, 25 assets, multi-family apartment complexes, trailer parks and storage complex. And of all those, like two or three that had variable rate debt just punished us because,
Yeah, I would say I mean, it's not necessarily the variable rate debt. I mean, it got so bad it didn't even matter. It was just, quite
yeah,
frankly, even if you had fixed debt or rate caps in place, it didn't really matter. It was just the term, right? The
yeah,
term
the,
of that
the end of,
loan.
end of term where they expire. And it's been interesting. So we had a few that expired, and most banks were just like, we're just going to pretend it didn't expire. Sam, you guys keep paying. I'm like, yes, we'll keep paying. But like, I can't get new debt right now. Like, nobody will do the loan, or the loan is, 40% lower than it was a year ago, or what we could have gotten a year ago if we would have refinanced at that time. And so they were just like, they're fine with it. There was only, I think, one lender that we had issues with. But everybody else was just keep praying, because the lenders needed the money, and they needed to stay afloat. And the ones who called all the notes, I guess a lot of those lenders went under. Right? They just went under. So the smart guys hung out there and said, "We'll work with you. Let's get this thing done. We'll take less proceeds or whatever." On a refinance, and they were exited, and it was great. Or they hung on for another year or 2 years. In one case, we have one that hung on for 2 years, and they're just been fine. How's it going on the sell? Well, we're trying. The market's really tough right now, um, and they've been fine. It was great. And those are the smart lenders, Corvest, some of the other bigger lenders, and they've done well. I think in the marketplace, there's probably a couple of $1 billion worth of loans that are all matured and they're just extend and pretend still, 2 years later since the run up craziness. So
Yeah, and
that,
I
yeah.
think people look at that and they're like, "Well, there's this like at some point it needs to come through." But in reality, the way I look at it is like, those projects that it's all your basis at the end of the day, what you bought the property for. Those projects that you're talking about, unfortunately, you can't really do anything about it. The basis is just high. Whereas like right now under people's noses, and if you're kind of lucky enough to not be, kind of entering the scene now, you're picking properties at kind of we never know when the low is, right? For all we know, the low could have been 6 months from now, but it's a tale of two tapes in a way. It's
Mm-hmm.
the, the, the old deals with the high basis and the ones that are now with the lower. And, it's, if you can couple today's pricing with long-term debt, 5 year, 8 year terms, you should be able to, hold the deal long enough for these cap rates to return back to steady state and normal is the idea. Again, we don't know what's going to happen in the next 1 year, 2 year, maybe even 3 years. But that's why if you're able to get a loan package with a long enough term, you can kind of get a little bit more certainty when
Mm-hmm.
there's always risk, right?
Yeah. You really need 10 years, right? You need 10 years on that note that you can sit and execute the business plan and then hold and wait. And then when the market is frothy, that's when you sell.
Yeah, I think that would be, I would say that's a conservative statement there. But the problem is, people are like, why don't you always do that? It's like, well, the longer the term debt you get, those loan packages, they're gonna be a little bit more costly, right? And so that in a way, it's kind of like paying a little bit of insurance. It's not an
Mm-hmm.
insurance product, but it kind of is the way to think about it.
Yeah. And investors have been trained to think, I want my money back in 3 years. It's about the velocity of my money coming back to me. Well, the government says the faster the money comes back to you, the more they're going to tax you. And so you may make a higher IRR because your money came back fast, but they're going to grab 29%, 39% of that profit right out of your pocket. And so the longer term holds provide stability and wealth creation, but you have to have a longer term attention span to
Yeah,
handle that.
and that's kind of where like, and it might be different from other people. This is just my opinion, but if I'm gonna be in real estate, I want longer terms, and I'm just gonna be more slow and steady. If I double my money in 5, 10 years, great. I mean, part of that is the tax benefits too.
Mm-hmm.
But if I want higher alpha, meaning like, I want a higher return and I'm willing to take on a little bit more risk, I'm going to go outside of the world of real estate or develop, right? Real
Yeah.
estate. So it's kind of like, you kind of go to, picking a certain asset class. And then in that asset class, there's a handful of very prominent business plans, right? Like in real estate, you can have um, light cosmetic renovations, lipstick on a pig, bump rents up, and over 5 years, and long-term debt. You can go in with a bridge note, do a little bit more aggressively, higher returns, maybe over 20% IRs in some of those. But if the interest rate's correct and you have a shorter term loan under 3 years, you can definitely get caught.
Yeah.
But that's why I say diversify, right? And pick your poison. They're all they all have a certain element of risk, but I do think that the risk to reward, I mean, spectrum, there is consistencies. The more risks you take, the more rewards you get.
Well, I think that's really sage wisdom. It's really great advice. It's always good to talk with somebody who's been in the market, who's gone through um, the wealth elevators you're talking about. You've gone through the rookie, the adolescent stages, the learning, the growing, the pains, um, and a lot of these things people just don't share on social media. They just share, hey, we did this deal and we gave our investors a 40% IRR because they flipped the apartment complex in a year and they happened to sell in 2021. And Like you can't repeat that today. At least not in multifamily. You're most likely not going to repeat it. I guess there are some occasions where that can still happen, but um, and that's just a very, very risky game. It's also a very tax burdened game. Um, Whereas there's other places where you can play that game and it's not quite as risky as it is in real estate, trying to turn things really, really quickly. This is a slow and steady race. It's also, when it's done right, it's a very low risk um, investment opportunity relative to Bitcoin or the stocks, which are all very high risk investments, not tied to actually any physical asset. And at the end of the day, no bank's going to loan against a non-physical asset or not something that's producing revenue. You can get loans to buy companies that don't have physical assets, but that's because they have income, verified income. So we spent now a little over 45 minutes talking about a lot of different things, Lane. I hope our listeners are able to hear your wisdom, and would highly recommend, if you haven't checked out Lane's book already, to The Wealth Elevator, just tell us a little bit about that book real quick, and then where can we find you, Lane?
Yeah, so like I try to make a book more for accredited investors and try to like differentiate these paradigms that you go through, right? The basement level, the first floor, that kind of where I started, then the second floor where you're starting to invest in syndications, and then what do you do when your net worth, you hit that what I call end game level, $4 to $5 million net worth, right? How does your investment portfolio change? So it's written by engineers, so there's a chart in there in the middle, kind of the pullout section that kind of summarizes like these different floors, and then what do you do in terms of retirement plans, and then taxes, and then when do you do an infinite banking plan, right?
Mm-hmm.
Things like that, because this is what nobody, that was kind of the void I saw, was like nobody kind of pieces together what do you do after the first million. And then, we kind of talk about some of the higher levels of the floor, the people that I'm kind of starting to interact these days, people above the 10, $20 million threshold, right? Not quite that $100 million family office level. But, what I see most people do is like, you get yourself to 4 or 5 mil, you're going to gracefully get to 8 figures, by the time, you go. But how do you optimize, I think that's the hard thing, is like a lot of people like myself, we all work out of scarcity. Like we're just saving money, saving money, saving money. If people have read the book Die with Zero, it's very more of an esoteric approach of like, how do you trade your money for experiences and certainly time too. But, part of that is like, when do I know I have enough, and what is like the plan before me? Like if I knew what I knew now, would I have bought 5, 10 rental properties back in the day? Probably not. But I think that's the thing, is like either read my book or get around other people that are kind of on the next floor above. Yeah, if people want to check that out, you can go on Amazon, The Wealth Elevator, and then my podcast, The Wealth Elevator, is on there. But yeah, thanks for having me.
Thank you, Lane. I really appreciate it. I love the impact you're having in people's lives, the difference you're trying to make in helping them take those next steps and understand what to do, because you're right. There's not a lot of people out there telling them what to do. It's all what sells. It's like, hey, your first deal, like that's what sells in the marketplace. But what about everybody else who, wants to go beyond and become something more and grow their wealth? Thank you for sharing that. Thank you for the book on Amazon, and we'll share all these links in the show notes so that folks, you can go in and click the link and go straight to his book as well as to his website. And Lane, thank you so much for being on the show, man. I really, really appreciate it.
I appreciate it.
Thank you for tuning in to Clean Money, where we talk about sustainable investing that improves society. We are passionate about creating great investment returns to investors who want to use their money to make a positive social impact in the world. If you enjoyed the episode, we'd appreciate a 5-star review. And if you are interested in making your investing matter, please connect with us at wildmountaincapital.com, or you can find me, Samuel Sells, on LinkedIn, on Twitter at Sells_Samuel, on Instagram at Clean Money Sam, or on Facebook. And finally, make your investing matter.